Well, good afternoon, everybody. Welcome to the February 15th, 2024 regular meeting for the San Diego Community Powers Finance and Risk Committee. My name is Mayor McCann, the chair of the committee, and representative for the city of Chula Vista. We welcome members of the public, San Diego Community Power staff, and our committee members joining us in person. I wanted to thank the San Diego Community Power staff for making this in-person meeting possible, and the city of San Diego for their accommodations today. With that, I would ask the clerk to call.
Director Parent,
Here.
Director Aguirre. Here. Chair McCann.
Present.
We have a quorum.
Great. And as I'm a sucker for veterans, Dr. Washington, if you could allow us to go ahead and lead us in the Pledge of Allegiance.
My pleasure. Right hands over your heart. Begin.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
And Madam Clerk, are there any items to be added or withdrawn or reordered on the agenda?
There are not.
Great. Madam Clerk, do we have any public comments for this agenda?
We do not.
Okay. And are there any written comments?
We have no written comments.
Outstanding. Before we get to the first item, I do want to welcome aboard our new attorney for San Diego Community Power, Vera. And just wanted to give you a minute or two if you want to introduce yourself.
Sure. Thank you very much. My name is Vera Tiagi, and today is my 2-week anniversary as the general counsel for the San Diego Community Power. I'm very happy to be here. I've been an attorney for almost 20 years. The majority of that time has been in the public sector. So I have a lot of background in government laws like Brown Act, public records. I've also worked pretty extensively in public contracting laws and procurement. And my entire career has actually been in environmental law. So I have a lot of CEQA experience as well. And a lot of my focus has been on this transition towards like cleaner energy and to zero and near zero emissions equipment to try to meet air quality goals. So this to me is the other side of that same sort of envelope that we are working on at this agency. So I'm very happy to be able to grow and further my career and work on not only the technology that needs this clean energy, but also on actually supplying the clean energy. So I'm very happy to be here. The team has been super welcoming and very great, and I couldn't ask for more. Thank you.
Great. Well, again, welcome. We're excited to have you here.
Yeah.
We will now move on to the approval of the item 1. Megan, do we have any public comments for item 1?
We do not.
Okay. I will now turn it over to the FRMC members. Do you have any comments or action?
Approve the minutes.
And do I have a second?
I'm actually going to abstain because I missed the meeting.
Okay, I will go ahead and make the second then. Madam Clerk, if you can please call for the vote.
Director Parent, how do you vote?
Aye.
Director Aguirre, how do you vote?
Abstain.
Chair McCann, how do you vote?
Aye.
Motion carries with Chair McCann and Director Parent voting yes and Director Aguirre abstaining.
Great, and now we will move on to item 2. This is a review of the treasurer's report for period ending December 31st, 2023. I will turn it over to Dr. Eric Washington to present the item.
Thank you, Mayor McCann, and to Mayor Gide and Councilmember Parent. Thank you so much for being committed to providing oversight to the Finance and Risk Management Committee at San Diego Community Power. To the San Diego community staff, public that may be in the room or online, welcome to the meeting. I'll begin by acknowledging also the work that the finance team has done in collaboration with our entire team at San Diego Community Power as it relates to budget, which is one of the key components of our treasurer's report. For the period ending ending December 31st, 2023. We reported net revenue to the tune of 806 million in net operating revenue, against 598 million in total expenses, of which energy cost is the larger portion of that expense, landing at 208 million in net position for the period. So I will point out that we had budgeted for a heat event for our fiscal period. Fortunately, we did not experience any significant heat events, but what that resulted in was revenue being off by about 5% relative to our budget. And then expenses, on the other hand, in a rising energy cost environment, drove up the cost of energy, which landed us at our net position relative to what we had budgeted for. And you'll see sort of a summary in the upper right-hand portion of this slide, and then graphically depicted in the lower right-hand corner of this slide. Next slide, please. This next slide is a comparative analysis of where we landed with our actual results relative to our projections. Those projections inform our budget, and so the outcome or the results are really similar to what we had actually, where we'd actually landed when we look at our budget compared to our actual results through the period ending December 31st, 2023. Next slide. So this slide serves as sort of a dashboard in our results year to date through December 31st, 2023. Again, net position provided a contribution into our reserves to the tune of 208 million, which added to our cumulative cash position of 392 million. Coupled with the availability on our revolving line of credit, we had access to total liquidity to the tune of about $500 million in assets. We currently have no debt, and we're tracking to about 80% of our reserve build to 180 days cash on hand target. Next slide. This slide shows that reserve build trajectory and days cash on hand, including the components of actual unrestricted cash and access to availability on our line of credit. Next slide. Our participation rate holds pretty steady and pretty solid at about the 96% participation rate, which really shows that our member cities, community members are really sticking with the Community Choice Aggregation Program and remaining our customers at San Diego Community Power. So that is one of the highest participation rates among CCAs across the state. And that concludes my report, Mr. Mayor. I'll pass it back over to you.
And Megan, do we have any public comments on this item?
We do not.
Okay, I'll see if any of the members up here, do they have any questions or comments?
Just a quick question about, has more to do with the snapshot of user enrollment participation. The snapshot, is that done annually? So I see here in the report, it says of May 2023.
So that's actually a monthly update.
Okay,
So that's probably the most recent data, and we'll confirm the date of this snapshot here and make that adjustment accordingly.
I think since we use that graph frequently, I think it would be helpful just to have the most recent date, just so we know where our cities lie in general.
Thank you for that feedback,
Thank you so much.
Madam Mayor.
Great. And if there are no more questions or comments, this is an item to receive and file. So we will go ahead and do that. And then we will now move on to item 3. And I will once again turn it over to Dr. Eric Washington to present item number 3.
Thank you again, Mr. Mayor. I'm joined by Tim Maglamont, our Senior Finance Manager. and Chris Doe, who's actually driving the slide deck for us on this presentation. So we're bringing to this group a recommendation for approval to advance this item to the board for ultimate approval at our upcoming board meeting. This slide is a slide development timeline that we typically follow in our budget development cycle. And we're just entering into that cycle for fiscal year 2025. That item will come before this group at a later date. But in terms of where we are in our overarching budget development timeline, typically in the month of February, we will do a mid-year budget review and make necessary recommendations for adjustment to the FRMC and then ultimately to the board for approval. So this is where we are in that budget development timeline. Next slide. So this slide is a comparative analysis of what was adopted back during our budget development cycle for fiscal year 2024, approved by the board in June of 2023, where we landed with regard to net operating revenue, total expenses, and then our net position. So what we're coming to this group with and ultimately to the board is a recommendation for adjusting our net operating revenue, was informed by the recent rate action that the board took back in the month of January that became effective February 1st. The total expenses, including adjustments to the cost of energy that were also included in budget amendment, and then ultimately the net position where we'll land as a result of this budget amendment. So this next slide shows the delta between the net operating revenue, the total expenses, and the change in net position. So I'll point out that revenues are up in this amended budget relative to the adopted budget, as are the total expenses, pointing primarily to the cost of energy and then the implications to our net position as a result of those two primary components. This next slide shows graphically by the numbers the side-by-side comparison. I'd like to point out that the non-energy cost, we really took a look at our operating budget to identify ways for people to reduce some of those line items to contribute to overarching budget. And we were able to identify over 3.5 million in savings on non-operating expenses. Next slide. So this slide categorically breaks down the comparative analysis of the adopted budget and the amendments that we're bringing forward to you now. Again, just pointing to the implications to our change in position. Next slide. So that concludes this presentation, Mr. Mayor. And again, we are seeking approval to recommend presenting this amended budget to the board for ultimate approval at the upcoming board meeting. Thank you.
Thank you, Dr. Washington. Megan, do we have any public comments?
We do not.
Okay, and the board, do we have any public comments or questions? Okay, this is an action item. Again, I want to thank Dr. Washington. I want to thank him for their work on this. And I will go ahead and make a motion to approve item number 3. Do I have a second?
I'll second.
We have a motion and a second. Clerk, please call for the vote.
Director Parent, how do you vote?
Aye.
Director Aguirre, how do you vote?
Aye.
Chair McCann, how do you vote?
Aye.
Motion carries with all directors voting yes.
Great. We will now move on to item number 4, presentation on clean energy payment financing. I will turn this over another time to Dr. Washington to present this item. Thank you.
Thank you, Mr. Mayor. We have a guest who will drive the presentation of this item. Mike Berwanger is joining us virtually, but just by way of introduction to this presentation. So You may recall from our strategic planning session and some of our previous committee meetings, as well as our board, we pointed to initiatives that the finance, with the support of the executive team, would bring forward for San Diego Community Power, pointing to ways that we're able to save or generate savings to support the rates that we set for our community members, or our ratepayers. And this is one of a few initiatives that we are pursuing at this time. So with that, I would like to yield the presentation to Mike Berwanger from PFM, the financial consultant or financial advisor that we're working with on this transaction as we move. Mike.
Sure. Thank you. Good afternoon, everybody. We can jump right in. Just pop up to the first slide there. That would be great. Thank you. So what we're talking about today is an energy prepayment transaction. The goal of the transaction, as Eric outlined, was to reduce the cost on your existing fixed price power purchase agreements by 8% or more. How are you going to do that? You will be, if you pursue this, you'd be leveraging the ability of San Diego Community Power to access the tax-exempt bond markets to do that. By way of background, this is a transaction that's been codified in the U.S. tax code for many decades. It has been around since the 1990s. It has largely been applied for natural gas in the Southeast. And there's been over 100 transactions done for quite a sizable amount of issuance. But what's notable for you is that in the last few years, the same financial technology that has been used extensively for gas also can be used for energy. And to date, there have been several transactions that have been done by your peers in California, totaling close to $10 billion in issuances. So if we flip to the next slide, please. You'll see this is sort of a snapshot of the other public utilities, the municipally owned utilities in the state, and their utilization of the same financial structure goes back to 2006. Most of these transactions were for gas, as I noted, a lot of them for natural gas plants. There were a couple of wind assets that had been financed as well. But you can see that a wide sort of grouping of other municipal entities within the state have been using this for a couple of decades. And if you flip to the next slide, please. This is the snapshot of just in the last few years, the application to PPAs. And you can see that there have been 6 other CCAs in the state that have all done transactions. We're up to about 10 now. I'd say that while we're targeting 8% or better, most of these transactions have been about 10% or more in terms of savings on the existing fixed PPA price. So if we flip to the next slide, just a quick sort of introduction on who would be involved if you pursue the transaction of this nature. There's yourselves. You would need to hire a prepaid counterparty. That typically is a financial institution who has a commodity presence. So there's a handful of banks that also do commodity business. You would need an issuer for the bonds. That's already been taken care of. There was a group of CCAs who had formed the California Community Choice Financing Authority, who has been the issuer for all 10 of the CCA-led energy prepayment deals to date. And so it is an entity that is there, formed by other CCAs, for CCAs, purely for the purpose of energy prepayment transactions. Your existing counterparties on your PPAs would be involved. And then obviously we would need, if we're selling bond obligations, we would need investors to buy those. What's notable about this transaction is that it is a non-recourse tax-exempt prepayment bond. I'll come back to this a few times. This is really important in terms of the risk profile of this transaction. If the worst happens, this is not your obligation to repay the debt. The debt would be repayable by a termination payment from the prepaid counterparty to the issuer, the CCCFA. There would not be recourse from the investors back to San Diego Community Power in terms of paying off the bonds. If we flip to the next slide, we'll get into, this is a little busy, it's a lot of boxes and arrows, but if you'll bear with me, there's really two pieces, the left side and the right side of this, that I like to maybe step through in terms of how the transaction works. And if you start at the very bottom box and we work our way up on the left side and back down to San Diego, you have an existing PPA. We will, on a limited basis, assign that PPA to a bank counterparty. Simultaneously, everything happens at closing at the same time. That counterparty is entering into an agreement to sell that same energy back to the CCCFA, that is that JPA issuer, and you would execute an agreement with the CCCFA to buy the same megawatts back. All of the RECs, all of the attributes associated with that energy would flow through the structure. So you end up back to where you started with the same energy. What's different is what's on the right-hand side of the equation, which is, and I'll start with your box at the bottom, whereas you were paying, let's say, keep the math easy for me, $100 on your PPA, now you're paying $90 on that same PPA. And that's your forward obligation, paying that $90 instead of the $100 to the CCCFA. The critical step here is the injection of that tax-exempt borrowing, where the CCCFA would sell those non-recourse bonds to investors, raise the capital to make that prepayment for that energy to the bank counterparty. Now, if we flip to the next slide, one of the questions we get, Mike, please explain to me where these savings come from. This sounds too good to be true or doesn't make sense. What is occurring with the prepayments? The bank is receiving a sizable amount of money up front. They value that as an alternative form of capital. So think of it as the bank would fund themselves by selling bonds in a taxable market at a rate of 5%. And instead of doing that, they can accept your prepayments and value that money at the same 5%. You were previously paying just as an illustration, you're previously paying $45 million a year on this PPA for that energy. That amount of money, that amount of power and the dollars that translates into would be discounted by the bank counterparty at that 5% rate. What you're doing is financing that amount with a lower rate because of the tax-exempt nature of the bonds. So they borrow at 5%, you borrow at 4.25% and pay going forward that 4.25% debt service on the bonds, which is only $40 million. So the delta between the 45 that you were paying on the PPA and now what you're paying on the bonds, effectively, that $5 million is the cash flow savings that will be generated, which is translated into that discount off of the fixed price PPA. I note that all of that would be quoted net of all the transaction costs for the various parties that are required to sort of put this together, your lawyers, your rating agencies, your bankers, all that fun stuff. If we flip to the next slide, one of the other questions we get is, can you explain exactly how this limited assignment works? We like our PPAs. We're not really interested in handing them over to somebody. You're not. You would be just assigning certain rights and obligations over to the bank counterparty, who is immediately, you're assigning the power and the dollars, but you're retaining all of your other rights that you've negotiated. If there's issues with the project or the counterparty, you continue to control the PPA the bank counterparty is not interested in PPA control. They're just interested in receiving the power, selling it back to CFA, who is then selling it back to you. The result being that 8% discount or more. The way to accomplish this would be to negotiate with your existing PPA counterparties a limited assignment agreement. This has now been done 10 times, so many of the counterparties that are the most active in the state with other CCAs as well as with your counterparties have already done this and already agreed to this for other transactions. So we're very comfortable that there would not be an issue with that in order to facilitate the prepayment arrangement. And then if we flip one more slide, this is my final slide, and I'm happy to take questions or go back to anything, Derek, if we need to. I think in terms of the financial transaction, from our view, is a very favorable risk allocation, which starts with the underlying nature of the obligation, which is take and pay. That's what you're doing today, right? You're only paying for the energy you're receiving from the PPA counterparty. If they don't send you energy, you don't pay anything. That's the same obligation here. Even though there have been bonds issued, if you're not receiving your energy, you're not making a payment. And if the counterparty fails to perform, that bank counterparty, investors have recourse to that termination payment that the bank counterparty is obligated to pay, not the revenues or the credit of San Diego Community Power or the members of the JPA. I won't go through every risk, but if there is a risk that you can think of in a transaction of this nature, it has been contemplated, and there are mitigation techniques and provisions that have been built into the arrangements and the contracts so that there is something to mitigate the potential for receiving too much energy that you don't need. If there's concern about a default, I walked through that there would be a termination payment. And I think it's really important to understand that from a rating perspective, they treat this as non-recourse debt, meaning that it's not considered your debt. It's not on your balance sheet. It's not accounted for like other debt you may be accustomed to at your own agencies on your balance sheet as on your credit. That's not how this is treated. It's not the way the rating agencies look at it, and it's not the way that the investors look at it. I'll maybe stop there. I know I went through that at a pretty healthy clip, so I'm happy to take any questions or go back through anything, Eric, as folks might need.
Thank you, Michael. I'll turn it back over to you, Mr. Mayor.
Thank you very much. Do we have any questions for the presenter? Mayor Aguirre?
Thank you. Just to clarify the last slide, if you can go back to that. But just to be clear, if hypothetically, not that there's any way it could, but the CCCFA were to go under, for example, all of the previously agreed to transactions payments would not be held liable for those or be affected negatively by them in any way?
Correct. So just like for you, the CCCFA is not obligated on the debt either. So if the worst happens and the counterparty defaults, all of the transaction would unwind. The counterparty needs to make a termination payment to the CCCFA, who would use that to pay off the bondholders. And then any limited assignment on the PPAs would be torn up, and the PPA cash flows and the power would come right back to you.
But that's if the counterparty were to go under, but what if the CCCFA itself were to hypothetically just go away? I don't know. Is there any, you see what I'm saying? Yeah.
Yeah, great question. Yeah, the way the CCCFA has been structured, it really is it's very much like a financing authority for any of your cities. It's there to help facilitate the issuance of the debt, but it's not as if that authority has 25 people working for it, or really serves in any broader role other than to sort of facilitate the transaction, if that makes sense.
Okay, thank you very much.
Certainly.
Thank you. Member Parent?
Yeah, thanks for this presentation. The sounds like an attractive financing option for PPAs. Are we contemplating using this model for all of our future PPAs, or for a subset, or what are the thinking about how this might fit into the overall portfolio of PPAs that we enter into?
So Mike, I'll take a stab at that. That's a great question, Councilmember Parent. Thank you for asking it. So as we enter into these transactions, it would be sort of a review of the PPAs and which ones might make sense to go into this type of transaction. I don't think that it would be a scenario where all of our PPAs go to a transaction such as this. The main objective is to identify those that could go in to generate as much of a discount or savings as possibly can. And primarily, what would go into these types of transactions, Michael, jump in here at any time, but I believe these are only focused on long-term PPAs as opposed to some of the short or intermediate term PPAs that we might have in our. Does that sound about right, Michael?
Yes, that's correct. We'd really look at the longer term, renewable oriented PPAs. Every one of these transactions has also been a green bond in terms of its environmental impact.
What is like the when we're saying something that's long term and therefore attractive to this kind of model of financing, what's the term? Is that more than 2 years, more than 10 years?
10.
10. Oh, okay.
Correct.
Okay. Okay. And is that because bond investors want to, just that these are big and they need to be over a certain size or scale to justify the administrative hoops that one has to jump through in order to set something up and do that? Is that why the duration of an investment is the factor?
Yeah, those are a couple of the many reasons. There's regulatory aspects where focusing on longer term PPAs makes more sense. And then the nature of the transaction benefits. The longer the transaction, the higher the potential for savings. All of those transactions that were done were actually 30-year transactions. So the longer the PPA in the structure initially, the better off in terms of just the predictability within the nature of the structure.
And then I think this is my final question: is this model of financing available to us because we're a public entity, and or is our private like investor-owned utilities able to use similar types of financing structures for their operations?
It is uniquely applicable to yourselves and other municipally owned utilities. Yeah, and so by definition, the IOUs cannot use a structure like this. Correct.
Yeah. Okay. Yeah. Yeah. Thanks for clarifying all that. Yeah. No, I appreciate this, and I also I think this is a good idea, and we should have these opportunities or these tools in our toolkit. And I want to also thank the staff for looking to figure out how to maximize all the ways that we can to utilize our position as a public agency to get access to capital at affordable rates, and to do everything we can to procure energy that's not only green but also more affordable to our ratepayers. And so we should just use we should just work every angle, and I'm glad that we're pursuing that with this idea as well.
Thank you very much. And Megan, do we have any public comments on this item?
We do not.
Okay, great. And any more questions or comments by the board? Well, thank you very much for the presentation. This is an item that was just a presentation. So we'll go ahead and accept this and receive and file. Thank you. Now we'll move on to item number 5. This is for the approval of a professional services agreement with Chandler Asset Management. And I will go ahead and give this over to Dr. Washington.
Again, thank you, Mr. Mayor and committee members. And keeping along the line of the theme and comments from Councilmember Parent is really working every possible angle as we can within our purview to really point to making rates and procuring energy at lower costs to the extent possible, with the ultimate intent to pass those off to our ratepayers to the extent possible. So this next item is approval for recommendation from this group to advance this item to the board for approval. And this PSA is with Chandler Asset Management Group. Next slide, please. So just a bit of background and history on this this action item or this agenda item. You'll recall back in May of 2025, the finance team in support by the executive team brought to the board a recommendation for approval of an investment policy, which the board approved unanimously. With that, the intent was to be able to leverage our reserves into forms of investments that might yield us a rate of return that we could, do multiple things with, including pointing to ways that we can reduce rates for our customers, fund programs that would point back to insertion into the communities that we serve. In December of 2023, the finance team under the leadership of our procurement manager, Christopher Stevens, initiated an RFP to seek investment portfolio management and advice. And as a result of that RFP, landed after we did our evaluation with Chandler Asset Management. Chandler Asset Management is a local investment management firm that has currently about 34 billion under management. Familiar with investment management for municipalities as well as other CCAs in their portfolio. So it seemed a great fit for us after running that RFP process and the evaluation process that we landed with Chandler Asset Management. So this item would be advanced to the board, ultimate approval, allow staff to execute on that agreement and ultimately engage Chandler to invest some of our reserve funds in accordance with and in compliance with the policy that has been approved by the board. Next slide, please. And this is a transition timeline of what comes after the agreement is in place. And there's to some extent about a 4-week process to get us to the point where we are actually engaged in investing Chandler Asset Management. Again, this item is an action item of seeking approval from the FRMC for advancing this item to the board for ultimate approval. That concludes my presentation. Mr. Mayor, I'll pass it back to you.
Thank you very much, Dr. Washington. Megan, do we have any public comments?
We do not.
Great. The board, do we have any questions or comments? Okay, thank you very much. I just again wanted to thank Dr. Washington and his staff for again looking at this and making sure that we can are appropriately looking at things on how we can help save our ratepayers money, as well as how we can make sure we can keep financially stable and continue to thrive. So I will go ahead and make the motion to approve item number 5. Do I have a second?
I'll second.
I have a motion and a second. Megan, can you please call for the vote?
Director Parent, how do you vote?
Aye.
Director Aguirre, how do you vote?
Yes.
Chair McCann, how do you vote?
Aye.
Motion carries with all directors voting yes.
Thank you very much. Now we're gonna move to committee member announcements. Do we have any announcements? Okay, no announcements. And then, from staff, do we have any staff or, comments from our new, attorney?
Nothing from staff, and I'll give to Mary for any comments. Thank you, Mr.
Nothing for me other than thank you for letting me be here today. And I look forward to continuing to join you all in these meetings.
Well, we're excited to have you here. That brings us to the end of our agenda. And I want to appreciate everybody's participation today. And we will now be adjourned till our next regularly scheduled meeting on March 21st, 2024. We now are adjourned. Thank you.
Okay.
Thank you.
So.
Oh, yeah, we were on. We were, I do.